Okay, let's dive right in. Today, we're really digging into something huge. The incredible growth and, frankly, the superior investment performance of Bitcoin. You shared some really compelling research detailing how this asset has scaled. And our mission here is to cut through the noise, get past the hype, and understand the real, measurable trends making Bitcoin, well, a legitimate financial asset now, moving beyond just speculation. I think we have to start with that one number.
Yeah.
The one that just makes everyone stop and pay attention.
Oh, yeah, and it's a big one. The sources confirm as of the afternoon of October 6th, Bitcoin's total market cap hit an absolutely staggering $2.5 trillion.
Yeah, $2.5 trillion. So this thing launched, what, 2009?
That's right.
It's now valued more than some of the biggest, most established tech giants out there. I mean, that's not just growth. That feels like a fundamental shift in how value is seen globally.
It absolutely is. And that scale, that $2.5 trillion, it's really the starting point for the key question, isn't it? How did it get here? And, what exactly is winning over all that skepticism from the early days? To figure that out, we definitely need to look at the returns, the sheer performance, but critically, we also have to look at the cost, the risk involved in getting those returns.
Okay, yeah, let's get into the performance then, because if you want to see why money is moving here, the numbers themselves tell a story. We're talking about the 5 years leading up to early October 2025. And Bitcoin's price growth in that period, it was, well, extraordinary, a 1,060% gain.
1,060%. It almost sounds unreal, right? Which is why the sources give that really concrete example. Think about this. If you put $10,000 into Bitcoin back in early October 2020, just 5 years later, on October 6th, that 10 grand, it would have grown to $115,700.
Wow, $115,700 from $10,000. That's the kind of return that makes even the most traditional investors, really sit up and pay attention. And the material you shared really hammers home how different that is. You compare it to the traditional stock market over that same 5 years. I mean, the stock market did okay, sure, but it doesn't even come close.
Yeah.
We're talking completely different leagues of wealth creation here.
And this is the really important, but the sources emphasize that performance didn't happen smoothly. It was achieved despite extreme volatility. You just don't get a 1,060% return without taking on some serious risk.
That's the fundamental trade-off, isn't it?
Yeah.
Massive potential reward, but tied directly to significant risk. And to really grasp that risk, we need that market snapshot you mentioned. It shows those wild price swings immediately.
Exactly. So the current market cap, we said, around $2.4 trillion. Huge. But look at the price itself. Around October 6th, it was roughly $121,912. Now, that might sound high and stable, but then you look at the 52-week range provided in the sources.
Right.
The low end in that year was about $58,935. The high end, $126,079.
So from under $60,000 to over $126,000, all within 12 months. That tells you everything about the volatility. Even as it becomes more legitimate, its price moves in ways traditional stocks just don't. And that kind of movement needs explaining.
It does. It really underscores that while big institutions are coming in, they're embracing an asset that's still defined by pretty dramatic price discovery. So this is where the real deep dive starts, I think. We shift from what Bitcoin has done, the returns, the scale, to why. Why this spectacular rise? It's not random. The sources point to 3 really powerful interconnected trends driving this.
Okay, let's break those down. The first one seems tied most directly to the big picture, global economics. Bitcoin is a scarcity hedge.
Right.
When the sources talk about massive government spending, rising debt, they're really talking about a decline in confidence in traditional fiat currencies, aren't they?
That's exactly it. When governments spend heavily and take on more debt, they often, increase the money supply to manage it all. You flood the system with cash, and that cash starts looking for somewhere safe to go, somewhere that can hold its value against potential inflation.
And this is where Bitcoin's core design feature comes in.
Precisely. Capital has flowed into Bitcoin because it offers something pretty unique in finance today: a hard supply cap. It's built in. There will only ever be 21 million Bitcoin, period. That's not a policy that can change. It's mathematical code. It's certainty.
So it's like capital is literally choosing math and predictable scarcity over government monetary policy decisions. It's a clear signal that worries about debt and inflation are pushing serious money towards assets that can't just be printed indefinitely.
Exactly right. Historically, gold played that role, didn't it? When investors got worried about inflation, they bought gold. Bitcoin is increasingly seen as maybe a digital version of that, a modern, arguably more accessible safe haven, and the ongoing macro pressures the spending, the debt, they're just accelerating the demand for this kind of scarce asset.
Okay, so that inherent scarcity creates the demand. But the second major trend you mentioned is what actually allows the traditional financial world to act on that demand, the institutional embrace. And this seems to be happening fast.
Also, incredibly fast. We're seeing the financial services industry integrating Bitcoin in lots of different ways. But the big one, the most significant development mentioned, is definitely the introduction of spot Bitcoin ETFs, exchange traded funds.
Explain that for our listener. Why is a spot ETF such a game changer? How does it fundamentally alter how institutions adopt Bitcoin?
Well, think about the difference between, say, trying to buy and store physical barrels of oil versus just buying an oil stock ticker in your normal brokerage account. Before spot ETFs, big institutions wanting Bitcoin exposure faced real hurdles, like where do you securely keep billions of dollars worth of digital keys? That's the custody issue. Plus, there was a lot of regulatory fog. The spot ETF basically solves those problems. It lets huge players, pension funds, endowments, big wealth managers get exposure to Bitcoin's price movements using a tool they already know and trust, a regulated security. It dramatically lowers the barrier to entry. It essentially opens the floodgates for massive amounts of capital to flow into the Bitcoin market much, much more easily.
Got it. So the ETFs didn't just add another investment product. They fundamentally changed the access mechanism for the world's largest pools of money. They de-risked the process of buying in. And that kind of institutional integration, it can only really happen if the surrounding environment allows it. Which brings us neatly to the third powerful trend, the regulatory picture.
Yes. The perception, according to the sources, is shifting towards a more favorable regulatory backdrop. And this is absolutely essential infrastructure. When regulators start providing clearer rules, it reduces the uncertainty. And uncertainty is what paralyzes big, cautious institutional money. Clearer rules give them the green light.
So a more positive regulatory outlook means companies can invest in building the infrastructure around Bitcoin custody, trading, innovation with more confidence. And the sources suggest this bodes well for Bitcoin's future, precisely because it creates stability for all that new capital that's flowing in via things like the ETFs.
That's a great way to put it. Think of it like this. The scarcity, the macro pressure, trend one, that provided the reason for capital to move. The ETF, trend two, provided the easy vehicle for it to move. And the improving regulatory clarity, trend three, is paving the road for that movement to be sustainable and grow. These three forces aren't working in isolation, they're feeding off each other. Perfectly in concert, really.
That synthesis seems like the core takeaway here. We're looking at an asset that's hit this truly extraordinary valuation, $2.5 trillion, driven by this deep-seated need for scarcity in an inflationary world, and by the creation of traditional regulated ways to access it. Those incredible 1,060% returns over 5 years. They're basically the result of these powerful forces colliding.
And what really stands out, I think, and maybe what you, our listeners, should really focus on, is the sheer direction of that capital flow. When serious money explicitly moves towards an asset defined by a hard supply cap, and it's doing so directly because of concerns about government spending and money supply, well, that's a powerful statement. It signals a kind of fundamental search for an alternative store of value outside traditional systems.
So the big question then becomes,
Mm-hmm.
what does all this institutional momentum and ongoing macroeconomic pressure mean for the next few years?
Exactly. It really makes you wonder about the future shape of finance, doesn't it? I mean, if the leading cryptocurrency is now being valued higher than some dominant established tech companies, and the main engine behind it seems to be this persistent need for a hedge against government debt and inflation, well, how much further does that push institutional adoption? How much higher does the valuation go? It suggests that maybe, just maybe, integrating these kinds of scarcity-based digital assets into the mainstream isn't just some temporary trend. It could be a much deeper structural shift in finance. And perhaps we're only in the early stages of seeing how it plays out.